Hello everyone. In this video you will get useful insights about asset pricing paper of Fama French 1992, and the name of the paper is cross section of expected stock returns. So let's move toward the brief introduction about the paper. The asset pricing model of Sharp, Linter, Blake has long shaped the way academics and practitioners think about average returns and the risk. The central prediction of the model is that the market portfolio of invested wealth is mean variance efficient in the sense of Markowitz. The efficiency of market portfolio implies that expected returns on the securities are positive linear function of market betas, which is the slope in the regression of the securities return and the market's return. Second, the market betas are sufficient to describe the cross section of expected returns. However, there are several empirical contradictions of the Sharp Linter Blake model. The most prominent is the size effect suggested by the Benz in 1981. He finds that the market equity, which is stock price times share outstanding, adds to the explanation of cross section of average returns provided by market betas. He said the average return on small stocks are too high given their beta estimates, and the average return on the large stocks are too low. Another contradiction of the SLB model is the positive relationship between leverage and average return documented by the Bhandari 1988. He said that it is plausible that leverage is associated with risk and expected returns, but in the SLB model, leverage should be captured by market beta. He finds that, however, the leverage helps explain the cross section of average stock returns in tests that includes ME as well as beta, ME which is size. And similarly, Satman in 1980 and Rosenberg, Reid, Lansing in 1985 finds that the average returns on US stocks are positively related to the ratio of firms' book value of common equity and its market value, which is ME. He says also Laconish 1991 finds that the book to market equity has a strong role in explaining the cross section of returns on Japanese stocks. Finally, the about earning prices ratio, Basu in 1983 shows that the earning prices ratio of helps to explain the cross section of average returns on US stocks in the test that also includes size as well as market beta. So all these variables can be regarded as different ways to scale stock prices. So since earning prices, size, leverage and book to market equity all are scaled version of the price, so it is reasonable to expect that some of them are redundant or describing average returns. Therefore, the goal of this paper is to evaluate the joint role of market beta, size, earning price ratio, leverage and book to market equity in the cross section of average returns on New York Stock Exchange, American Stock Exchange and the Nasdaq stocks. Moving towards the method they used to evaluate these joint role of several multiple variables, they use non-financial firms in intersection of the New York Stock Exchange, American Stock Exchange and Nasdaq return files from the Center of Research in Security Prices, which is CRSP, and they merge the computed annual industrial files of income statement and balance sheet data, which is also maintained by CRSP. They exclude the financial firms because of the high leverage. They said that the normal leverage for these firms probably does not have the same meaning for non-financial firms, where the high leverage are more likely indicate the distress. In simple words, the financial firms and non-financial firms are differs to each other in leverage. Next, the computed data for earlier have the series selection bias. The pre-1962 data are titled toward the big historically successful firms. So in order to avoid the selection bias, they started their study periods from 1963 to 1990. Also, they used a mix of different fiscal year ends, because they suggested the accounting data for all fiscal years in the calendar year T minus 1 with returns for the July and June of T plus 1. The gap between accounting data and matching returns varies across firm. That's why they use different fiscal year ends to study. Moving towards the estimated market betas, the asset pricing test used the cross-sectional regression approach of Fama French, Fama Macbeth 1973, in which the each month of the cross section of returns on stocks is regressed on variables hypothesized to explain expected returns. The time series means of the monthly regression slopes that provides standard test of the different explanatory variables are on average price. Since size, earning prices, leverage, and book to market equities are measured precisely for individual stock, there is no reason to summarize the information in these variables by using portfolios in the Fama Macbeth regressions. So, the approach is to estimate the betas for portfolios and then assign the portfolio's beta on each stock in the portfolio, which allows them to use individual stocks in the FM asset pricing regression. Now, the more details about the estimation of beta includes that all New York stocks are on CRSP are sorted by size, which is ME, to determine the New York Stock Exchange decile breakpoints for ME, NYC, MX, and the Nasdaq stocks that provide the required CRSP computed data and then allocated to 10 size portfolio based on the NYC breakpoints. They form the portfolios on size because the evidence from the Chan and Chan 1988 and others that size produces a wide spread between average returns and the betas, whereas Chan and Chan use only size portfolios, which creates a problem in which they in the paper they suggest that the size and betas of size portfolio are highly correlated about 0.998 in their data. So, asset pricing test lack the power to separate size from the beta effects in the average return. So, to remove this problem and to allow the variation in the beta that is unrelated to size, they subdivide each decile into 10 portfolio on the basis of pre-ranking betas for individual stocks. After assigning firms the size beta portfolios in June, they calculate the equal weighted monthly returns on the portfolio for next 12 months from July to the June. In the end, they have assigned the post ranking monthly returns for July 1963 to December 1998 on the 100 portfolios which were formed on the size and pre ranking beta. After that, they estimate the betas as sum of the slopes in the regression of return on a portfolio, or which is on current and prior month's market return. Referring to the Chen and Chen 1988 shows that the full period beta estimate for portfolios can work well in test of the SLB model, even if the true betas of the portfolios vary through time. If the variation in the betas is proportional, which is indicated by this formula where BJT subscripts JT is the true beta for portfolio J at time T, and Bj is the mean of Bjt across time, and beta is the mean for Bj. After that, they allocate full period post-ranking beta of a size beta portfolio to each stock in the portfolio. So these are the betas that will be used in the Fama Macbeth cross-sectional regression for individual stock for the analysis purpose. Now let's move towards the beta estimates, where table 1 shows that the forming portfolio on size and pre-ranking betas rather than size alone, which magnifies the range of full period post-ranking betas sorted on size alone. The post-ranking betas ranges from 1.44 to the smallest ME. You can see in the table panel B post ranking betas for smallest ME is 1.44 for the smallest, and which is moved to the 0.92 for the largest. In the blue circles you can see that the beta changes from smallest to largest. This spread of the betas across 10 size deciles is smaller than the spread of post-ranking betas produced by the beta sort of any decile. For example, the post-ranking betas for 10 portfolios in the smallest size decile range from 1.05 to 1.79. Thus, the pre-ranking beta sort achieve their goals. So they produce a strong variation in the post-ranking betas that are unrelated to the size. So this is important in allowing their test to distinguish between beta and the sides effects in the average returns. Moving towards the Fama Macbeth regression test results, which shows the time series averages of the slope from month by month Fama Macbeth regression of cross section of stock returns on the size and other variables such as leverage, earning prices, book to market equities that were used to explain the average returns. The average slope provides standard FM test for determining which explanatory variable on the average have non-zero expected premiums during the July 1963 to December 1990 periods. Like the average in table 3, say that size, which is ln e log of Markey ME, which explains the cross section of average stock returns. Here you can see the average slope from monthly regression of returns on the size alone is the negative 0.15% with t statistics of negative 2.58. In green circle you can see this is the reliable negative relation persists no matter which explanatory variables are in regression. The average slopes on the ME are always close to or more than 2 standard errors from 0. It shows that the size effect. It shows actually the size effect, which says that smaller stocks have higher average return. Is thus robust in the test results in the period of 1963 to 1990 returns on the New York Stock Exchange, American and the Nasdaq stocks. So, in contrast to the consistent explanatory power of size, the FM regression shows that the market beta does not help explain average stock returns for 1963 to 1990. In a short straight that the heard of the SLB model, the average slope from the regression of the returns on B alone you can see in the table, which is circled by the red line, which is 0.15% per month and only 0.46 standard errors from 0. Moving towards the next variable, which is book to market equity, we suggest that the FM regressions confirms the importance of book to market equity in explaining the cross section of average stock returns. The average slope from monthly regression on the returns on the book to market equity is around 0.5%. Here you can see in the table with a T statistics of the 5.71. It shows that the book to market relation is stronger than the size effect, which produce T statistics of 2.58 in the regression of returns on the LNME alone. When both the market LNME and LN book to market equity are included in the regression, is evidence the average size slope is still 1.99, with the standard error from 0 to the book to market slope is impressive 4.44 standard errors from 0. From next, move to the leverage. Results of the leverage. The FM regression that explain the returns with the leverage variables provide interesting insights in the relation between book to market equity and the average returns. In this paper, they used two leverage variables. First one, the ratio of book to market equity, which is assets ME, which is a ratio of book assets to book equity, and they interpret these two variables are used together to measure market leverage and the book leverage. The regression used natural logs of the leverage ratios. Here you can see the ME and LNBE, and FM regression of the returns on the leverage variables in this table pose a little bit of puzzle, which says the two leverage variables are related to average return but with the opposite signs. So this puzzle of the slope on the LNA and ME and LNA and BE has a simple solution, and the author suggests that the average slope of the two leverage variables are opposite in sign but close to the absolute value. Here you can see in the rectangle box, blue rectangle box, which is 0.50 and negative 5.7. Negative 0.57. In the absolute terms, they are very close. Thus, it is the difference between market and book leverage that helps explain the average return on the market equity. The FM regressions are indeed close in absolute values, so to the slopes of the two variables. In short, their results suggest that the relative distress effect that is captured by book to market equity can also be interpreted in involuntary leverage effect, which is captured by the difference between these two variables. Now moving towards the earning prices, results of the earning prices ratio. The average slope on the earning prices dummy variable 0.57 per month with the standard deviation of 2.28 confirms that the firms with negative earnings have higher returns. This dummy variable is used for the negative earning prices ratio, and the positive earning prices, they do not use the dummy variables, simply they use the data for positive earnings. The average slope for the stocks with positive earning prices ratio and shows the 4.72 per month with a standard deviation of 4.57, shows that the average returns increase with the earning prices with the positive. In a nutshell, if we summarize the table, the market beta seems to have no role in explaining the average returns on New York Stock Exchange, American Stock Exchange, and Nasdaq Stock Exchange for the period of 1963 to 1990, while the size and book to market captured the cross-sectional variation in the average stock returns that is related to leverage and earning prices ratio. Moving further, the more striking evidence which is presented in the table 4, you can see there is the strong positive relation between average return and book to market equity. The average returns rise from 0.3 to the lowest book to market equity portfolio to 1.83% for the highest. At the difference between these two is about 1.53 per month. And the similar average returns of the negative and high book to market equity forms are thus consistent with the hypothesis that the book to market equity captures cross section variation in the average returns that are related to the distress effect. Here you can see the average returns decline from 1.46% per month for the negative earning price portfolio to 0.93. In these red circles you can see it is declining for the firms in the portfolio 1B. Okay, and that have low but positive earning prices, where average returns then increase and reaching to 1.72% per month for the highest earning price portfolio, which is where you can see the red circle. It is from to these red circle is decreasing and afterwards they are increasing, and here you can see in the green circle. Now let's move toward the findings of the study. In short, their tests do not support the most basic prediction of the SLB model that the average stock returns are positively related to the market betas. Unlike the simple relation between the beta and the average return, the univariate relation between average return and size, leverage, earning price, and book to market equity are strong. But in the multivariate case, the negative relation between size and average return is robust to the inclusion of other variables. The positive relationship between book to market equity and average return also persists in the competition of other variables. So if the assets are priced rationally, the results suggest that stock risks are multidimensional. One dimension is the risk is proxied by size, which is ME, and another dimension of the risk which is proxied by book to market equity ratio to the common value equity to its market value. So whatever the underlying economic issues, the main result is straightforward for this paper.